In this video, traders, we're going to ask the question, trendline breaks, are they that good of a setup? Stay tuned. Hey guys, a very warm welcome to you. All right, so trendline breaks, are they actually that good? Now let's have a look at some of the metrics of the trade, some of the variables of the trade, the risk reward ratio of the trade, the probability that we think it's going to work out, and then let's kind of iron out and think, is it that good? And if it's not, how can we tweak and adjust it to make it a little bit better? So short-term traders, this is probably for swing traders. Let's say this market's been in a range for a couple of weeks, couple of months, whatever it may be, and we've drawn a trend line. Actually, we've drawn a channel in this example. You know, we've got a trend line on the upside, we've got a trend line to the upside, down to the top side of the highs, and on the lows generally is considered a channel, but if you just have one of those, it would be a trend line on the bottom. However, a couple of ways that the textbook would say to trade this is this: if you have a break to the downside, let's just extend our trend line a little bit here. If we have a break to the downside, then the textbook would say to us, we go short here on a break to the downside because there's a reversal happening. It's broken the trend line. We think there's going to be some kind of reversal. And technically, that's very sound. You know, the market's been an uptrend, now it's broken the uptrend. The idea is that the buyers aren't quite as aggressive as they were before. And, you know, we could end up being a reversal here. We're going to go lower. Now, the issue you have with that is you are always going to be taking, not necessarily, but if you're in this kind of environment, you might always be taking this after the price has moved a reasonable amount already. Now we know, guys, that prices are cyclical. We know that regardless of whether a trend is or not, the spring will stretch, it will contract, it will stretch, it will contract. And yes, there are plenty of examples where the market's just gone on and on and on and on in one direction without any pullbacks for days on end. But generally speaking, if you look at the most likely scenario, the most likely scenario for a market is it stretches for a few days, it pulls back, it pauses, it goes again if it's a trend. If it's not a trend, it will mean revert back some way, backfill, hesitate, range, all that kind of stuff. So if in this example, if you're shorting it here, you've already come down quite a bit from the high. So you've got a couple of things here you're looking for. Yes, the short is there. Yes, there's probably been some stops there. Yes, you've got momentum potential on your side. However, the market's already moved that much. So the probability of it moving even more becomes less. Now, I know there are exceptions. I know that if you've got true momentum, then you can almost disregard this. If there's catalyst to it, i.e. some earnings or something like that, then fine. However, statistically still, you're looking for something that's a bit of an unlikely scenario. Normal distribution of kind of market moves, you're right on towards the tail here because you're expecting the market to move persistently for a long period of time, which is a rare event in the markets generally. So you've got that, the probability of it working a little bit less, because the likelihood is if you're chasing this, it could easily come back, backfill a bit, and then roll over. The other thing you've got to think about, guys, is that all of a sudden, where's your stop going to be on this trade? Your stop is probably going to have to be above the high, because that's the idea of the trade. Now, you might argue and say, well, actually, I'm going to put it if it comes back in and have it at midpoint. But regardless of that, all of a sudden now, to get a good risk-reward ratio of 2 or 3 to 1, you've got to basically undo all of that trend. Now, is that likely? Well, it's possible, but is it as likely as perhaps coming back and doing half and backfilling half of the trend? If you kind of stuck a fib on or whatever and said, okay, there's 50%, I think I'll look for a 50% retracement. That's probably more likely. And so all of a sudden, you're not really worth taking the trade, because even though technically it's a good trade with a target of only half, and now you could argue and say, well, I'm always going to have my target at lows, but then you're expecting, again, much more from the market, which is unlikely to give you. Whereas if you say half a pullback, all of a sudden it becomes more feasible, but then the risk-reward ratio isn't right to do that. So what do? Okay, one thing you can do is you can say, right, you know what, I am always going to wait for a retracement and then take that as a short. So I want to see the trend, I want to see a break. Rather than jumping in on the break, I now want to see a retracement. Number one, because that means the market has contracted that spring and it's ready to go again. Number two, I now have a better place to frame my trade and place my stop. So, for example, rather than us going short on here, let's take some of this off here. Rather than it going short here, I'm now waiting for a retest potentially, or a double top and then a rollover. Now all of a sudden I've changed the dynamic of the trade massively. Yes, it's the same type of trade, it's a trend line break, it's a reversal type pattern, but rather than jumping the gun and going okay here, and you might say, well, it's almost the same price, but look at the subtle difference, guys. The subtle difference here is now, when we see this, where's our stop gonna go? Obviously, our stop can go here rather than here. Wow, that's a massive change in the risk order ratio. The entry now becomes something like this as we break this little support level here. Our stop is here. Now all of a sudden, this is, let's call it kind of 50 pips or whatever it is. All of a sudden it's 50 pips as opposed to 150 pips. And our price target, yes, in the 50% here, we might be pushing our luck a bit because it's probably only 1-to-1. But you get the idea. The point is now, rather than you have to have that such a wide stop, you've got a smaller stop. The risk reward ratio is better because you can quantify the risk better. And the probability of this rolling over is probably much higher than if you start chasing lows down here. You're probably gonna have to sit through a lot of heat. So if you don't like taking heat, this is something to consider because springs will stretch and they'll contract. So you want to see the spring stretch, then contract a bit, and then taking it for the next stretch. So it's thinking one move ahead. Now, many of you are going to go, well, it feels like I'm waiting too long and I'm going to miss some of these. Yes, you are. There's no free lunch in trading, guys. You are going to get times where this thing will just break and break and break, and you won't be in it at all. You'll be waiting for the pullback and you won't be in it. That's fine, because that counteracts the times when it does this and then just rips back up and does this, but just keeps going. And it's just a fake out. You end up getting stopped at highs, you end up taking a full stop on it, because of course you won't get the trigger, the subsequent trigger to get in on this type of move. So, very often you've got to think a little bit more of how to express the trade. Yes, technically, there's so many trades out there that look technically great. It's breaking a trend line, it's doing a head and shoulders, it's broke support, it's broke resistance, it's flagging, all these good stuff that work well. But when you actually put money on the line, you think about, how is my risk affecting this? How is my stop loss position affecting the quality of this trade? So how is the probability of the move affecting the trade as well? When you look for a really big move, all of a sudden you're going to extremes of probability. We start chasing it, you're looking for 6 red days in a row, or 7, 8 red days in a row, rather than just 3. Now all of a sudden you think, well, yeah, that's possible, but how many times? Just go and look at any chart. How many times do you get that over a couple of year period? Very rare. Now I'm not to say you can't pinpoint it, but why not put things on your side a little bit and say, okay, well, why don't I wait for a pullback rather than looking for 8 days in a row? Why don't I look for 5, 2 reds, a topping pattern, and then I look for 5 days in a row? All of a sudden, I've got such a better structure around the trade. I'm really thinking a little bit more about how to express the trade with the lowest risk possible. And actually, guys, if you look at if you read through any kind of hedge fund books or any of the market wizard type books, when you listen to what they're saying, very often a lot of people who are managing large amounts of money say, they have a trade idea. And let's say, they're not going to be taking trend line breaks, but whatever trade idea there is on a macro level, they have a trade idea. And then they say, I try to find a way of expressing that trade with the least amount of risk possible and the most amount of reward possible. So for them, they will go and say, well, should I be trading this country's currency? Should I be trading the index? Should I be trading this basket of stocks? Should I be trading the bonds? Should I be trading, that's a different decision. And they say, what vehicle? Should I be trading an option? Should I be trading a futures contract? So there's a different decision, but the same decision is almost for us, guys, is that, okay, we have a trade idea. How do we express that trade idea? Do we just dive in just because we think it's a trade idea? No, because that, even though it's a great idea, we know it still can be stopped out, we want to find a place where we can express that trade with the least amount of risk possible based on the structure, not just an arbitrary level, and also with a decent amount of probability of success. And the risk order ratio, we want to try to push those up, because regardless of whether this trade is great or not, if we're taking too much risk, if we're looking for too much of an outlier move, then we're just never going to work for us. So think about that, guys. So we're checking trendline break. Are they that good? They're okay. I think they're good. I think it's definitely worth looking for. But an extra tweak doesn't have to be this. It can be something different. Maybe you're looking for a flag. Maybe you're looking for a pullback to moving average. Maybe you start to preempt it when it starts to run out of steam up here or something. But just changing, going a little bit further than the textbook, just thinking a little bit more about how to reduce that risk can make all the difference. Take care, guys. Keep your risk managed, and I'll see you in the next one. Bye-bye.